a single-family home in South Florida, listed online with foreclosure-related signals, appeared for under $250,000. At first, that sounds like the kind of discount many investors are trained to notice. A real house, a visible discount signal. A market where affordability is hard to find. But here's the problem. The price you see is not always the cost you inherit. Behind a foreclosure-related listing, the real question is not only whether the home is cheap, it is whether the discount survives the ownership burden. Mandatory fees, monthly dues, condition risk, insurance questions, title clarity, and the process friction required to actually close. So before asking, is this a bargain, ask a more serious question. What is this low price transferring to the buyer? The discount is only the first number. A foreclosure-related price can create a very specific kind of temptation. It makes the asset feel measurable. You see the asking price, you compare it to other homes, you imagine the equity gap, and suddenly the opportunity looks simple. But a serious buyer cannot stop there, because the listing price is only the first number in a decision. It does not automatically include what may be waiting behind the purchase. Unpaid fees, community obligations, monthly dues, repair exposure, insurance uncertainty, title questions, lender timelines, or the difficulty of reselling a property that required more capital than expected. That does not mean the asset is bad. It means the discount has to be tested. In property risk intelligence, the question is not, how cheap is this house? The better question is, what must be verified before this low price becomes a real acquisition cost? The fee stack behind the discount. The first hidden layer is not always the roof, the walls, or the kitchen. Sometimes, it is the fee stack attached to the property. In many foreclosure-related listings, the visible price can be separated from the monthly reality of ownership. There may be association dues, community fees, mandatory maintenance charges, special assessments, transfer fees, or rules that affect whether the property can be rented, improved, financed, or resold. For a buyer, this matters because a low acquisition price can still produce a high ownership cost. A house listed below nearby alternatives may look discounted on day one, but if the buyer inherits recurring fees, unpaid balances, approval delays, or community obligations that were not fully understood before closing, the discount becomes less clear. This is where foreclosure analysis has to move beyond the listing. The question is no longer, is the price below market? The question becomes, what obligations come with the title, the community, and the monthly hold? The condition risk you inherit. The second layer is the condition of the home itself. Foreclosure-related properties are often presented with language that shifts responsibility to the buyer. As is, no repairs, limited seller disclosure. Those words may look standard, but for ownership, they matter. They mean the buyer may have to price the unknown before the unknown has been fully opened. In South Florida, that question can become even more important because the physical condition of a home is not only about cosmetics. A roof is not just a roof. It can affect insurance. A small moisture problem is not just a stain. It can become a repair path. A neglected system is not just an inconvenience. It can become a capital requirement before the property performs. So the due diligence question is not, does the house look acceptable? The question is, what repairs, insurance constraints, and immediate capital needs could be transferred with this property? The process risk behind the listing. The third layer is the process behind the listing. A foreclosure-related signal does not always mean the property is a simple bank-owned asset, ready to close. It may involve lender approval, a distressed seller, a pre-foreclosure status, a short sale logic, a process timeline that still needs to be verified, or documents that still need to be verified before the buyer can understand what is actually being transferred. For the investor, this matters because time is also a cost. Every delay can create carrying assumptions. Every condition can change financing. Every missing document can affect confidence. And every unclear title question can turn a visible discount into a decision that is not yet ready. This is why the wording matters. A foreclosure-related listing is not automatically a completed foreclosure sale. So the due diligence question is not, can I buy it below market? The question is, what process, title, and approval risks still stand between the listing and clean ownership. Insurance can change the meaning of the price. The fourth layer is insurance. In South Florida, this can change the meaning of a low price very quickly. A buyer may look at the purchase price and think the entry point is attractive. But ownership does not stop at closing. If the roof is old, if wind mitigation is weak, if prior damage is unclear, or if the insurer requires updates before coverage, the property may not behave like the listing suggests. The issue is not only whether insurance is available, it is whether the cost, conditions, exclusions, and required repairs still make the acquisition rational. This also affects the exit, because a future buyer may ask the same questions. A lender may ask the same questions. An insurer may ask the same questions. So the due diligence question is not, can I afford the purchase price? The question is, can this property be insured, held, financed, and resold under realistic ownership conditions? When the discount stops being a discount. This is the moment where the foreclosure discount has to be tested as a whole. Not emotionally. Not because the listing looks attractive, and not because the price is below a nearby comparable, but as an ownership equation. If the buyer adds the mandatory fees, the monthly dues, the immediate repairs, the insurance conditions, the approval delays, the title questions, and the future resale constraints, the real acquisition picture may change. The visible discount may still exist, but it may no longer be large enough to compensate for what the buyer is taking over. That is the distinction serious investors need to make. A low price is not the same thing as a protected decision. A discount only matters if it survives verification. So the due diligence question is not, how much below market is this property? The question is, after every ownership burden is priced, is there still a rational margin of safety? Due diligence advantage. This is the real advantage of due diligence. It does not make the buyer negative, it makes the buyer precise. A serious buyer is not trying to prove that every foreclosure-related listing is bad. The goal is to separate a real opportunity from a transferred burden. Due diligence turns uncertainty into decision language. This cost can be priced. This condition can be negotiated. This delay changes the timeline. This insurance issue changes the exit. And sometimes, the cleanest decision is not to buy. Real lesson. The real lesson is simple. A foreclosure price is not the same thing as a property decision. A report is not a decision. And a low price is not a decision either. The visible discount may be real, but the buyer does not only inherit the price. They inherit the fees, the condition, the process, the insurance profile, the title questions, and the exit reality. So before trusting the discount, test the ownership burden. Because in foreclosure-related real estate, the discount is only valuable if ownership can carry it. If this kind of property risk breakdown helps you think more clearly before buying, you can support the channel by liking the video, sharing it with someone evaluating real estate, or leaving a comment with the type of property risk you want to see next. It helps the channel grow and tells YouTube that serious property due diligence matters.